Hello friends, we will see today how to decide on the best financial plan for an organization. Okay, so we will go straight to the problem. Mitra Limited currently has an equity share capital of rupees 10 lakhs, consisting of 1 lakh equity shares of rupees 10 each. It requires rupees 6 lakhs for expansion and has the following financial plans under consideration. Financial Plan 1, issue of 60,000 equity shares of rupees 10 each, and then issue of 40,000 equity shares of rupees 10 each, and the balance through 12% borrowings. Issue of 30,000 equity shares of rupees 10 each and 3,000 rupees 109% debentures. Issue of 30,000 equity shares of rupees 10 each, balance through 6% preference shares of rupees 100 each. The EBIT of the company is expected to be rupees 4 lakhs per annum. The tax rate is 40%. Calculate the EPS for each plan and suggest the best plan. Calculate the financial leverage for each plan. So how do we solve this? We will see now. So first one, um, the equity share capital of the company as of now existing, this is existing is rupees 10 lakhs, consisting of 1 lakh equity shares of rupees 10 each. Now it needs another 6 lakh rupees for expansion program. And it has the different financial plans, 4 financial plans, and you need to choose the best for the organization. So we will make one table like this. Existing, the company has equity share capital of rupees 10 lakhs. This is the existing. Okay. Now, under the financial plan 1, 2, and 3, the existing will continue. It needs another 6 lakh rupees for expansion program. And the first option, first financial plan is issuing 60,000 equity shares of rupees 10 each. So if the company issues equity shares, 60,000 equity shares, so equity share capital will become 16 lakh rupees. That is 10 lakhs, which is existing, and 6 lakh rupees is the new equity shares issued. So the total capital of the firm, of the company, will be 16 lakhs. Now, what about the second financial plan? Issue of 40,000 equity shares of rupees 10 each. So that means equity share capital will become 4 lakhs. The balance means 2 lakh because the company requires 6 lakhs for expansion. So the second option is issuing equity share capital worth rupees 4 lakhs and going for borrowings, which is rupees 2 lakhs. So borrowing will be 12%. 12% borrowings. The third option is issue equity shares for 3 lakh rupees. So 3 lakh rupees, the company will issue equity shares and the company will go in for issue of debentures. Read the financial plan 3, 30,000 equity shares of rupees 10 each and 3,000 rupees 109% debentures. So the 3 lakh will be equity shares and 3 lakh will be the debentures. And the last financial plan is equity shares 3 lakh because 30,000 equity shares of rupees 10 each and the balance 3 lakh is preference shares. So 3 lakh equity shares and 3 lakh preference shares. Okay, so these are the 4 financial plans. And after you expand your business, that is after you choose the financial plan, then your EBIT is expected to be rupees 4 lakhs. So under all these plans, because your capital investment is 16 lakhs, so your EBIT under the various plans will be 4 lakhs. So now you have to choose the best financial plan for this particular organization. Is it plan 1, 2, 3, or 4? You have to choose. Now, if you are going in for only equity shares, That means there is no interest on borrowings, there's no interest on debentures, and there are no preference dividend. So earning EBIT under all the four financial plan will be the same. So there is no interest on borrowings, there's no interest on debentures. So EBT will be equal to 4 lakh minus 0, which is 4 lakhs. And then you have to pay 40% tax. So when you pay 40% tax, earnings after tax will be 2,40,000. There are no preference dividend because the company has not issued any preference shares. So the entire profit, that is EAT, belongs to the equity shareholders. Okay, so earnings available to equity shareholders is 2,40,000. Now, how many equity shares the company has issued? You know that it is 10 lakhs plus 6 lakhs, 16 lakhs. So 16 lakhs divided by 10 will give you the number of equity shares. 16 lakhs divided by 10 will give you the number of equity shares. So 2 lakh 40 divided by 1 lakh 60,000 will give you what is EPS. Earnings available to equity shareholders divided by the number of equity shares will give you your EPS. Now, moving on to the second plan. In the second plan, you have interest on borrowings. That is, on 2 lakhs, you have to calculate what is 12%. So interest on borrowings will be 2 lakhs into 12% is 24,000. No interest on debentures. Therefore, your earnings before tax will be 3,76,000. I repeat, 4 lakhs minus 24,000 will give you earnings before tax, which is 3,76,000. You have to pay tax at 40%. So 40% if you pay tax, you will get what is earnings after tax. And there are no preference dividends. So the earnings available to equity shareholders is 2,25,600. So what is the total number of equity shares? Total number of equity shares is 10 lakh plus 4 lakhs is 14 lakhs. 14 lakhs divided by 10 will give you 1,40,000. So divide this by 1,40,000. So earning per share is 1.61. Okay, moving on to the financial plan 3. Financial plan 3, there is no interest on borrowings, but you have interest on debentures. So interest on debentures is 3 lakhs is the face value of the debentures and the rate of interest is 9%. So calculate what is 9% of 3 lakhs. So 9% of 3 lakhs is 27,000. So from 4 lakhs, if you minus the debenture interest, you will get 3,73,000. You pay the tax, you will get what is earnings after tax. There are no preference dividend in this case. The entire amount goes to equity shareholders. So earnings available to equity shareholders is 2,23,800. Divide this by the number of equity shares. In this case, 10 lakh plus 3 lakhs is 13 lakhs. 13 lakhs divided by 10 will give you the number of equity shares, 1,60,000. So 2,23,800 divided by 1,30,000 will give you your EPS 1.72 rupees. Moving on to the last plan. The last plan, 3 lakh is your equity share capital and 3 lakh is your preference share capital. So for expansion, you're going in for equity shares and preference share capital. Okay, so EBIT is 4 lakhs. There is no interest on borrowing because you're going for equity shares and preference shares, no borrowings, no debentures. So interest on capital will be 0. Interest on borrowings will be 0. Interest on debentures will be 0. Therefore, what is your EBT? EBT is 4 lakhs. 4 lakhs rupees is your EBT. Pay tax at the rate of 40%. You will get what is earnings after tax. Pay the preference dividend. Now, preference shares you have. Therefore, this into what is the rate of preference dividend? It is 6%. So 6% of 3 lakhs is 18 lakhs. So you get what is earnings. Earnings available to equity shareholders is 2,22,000. This divided by the number of equity shares. How do you know the number of equity shares? It's 13 lakhs divided by 10. You get the number of equity shares as 1,30,000. So earnings available to equity shareholders divided by 1,30,000 will give you the EPS. Now in this, which one gives you the highest EPS? Financial plan 1 gives you 1.50. Financial plan 2 will give you 1.61. Here it gives you 1.72 and 1.71. So the one which gives you the highest return the um, to the equity shareholders, that will be chosen. So which one will you choose? The best financial plan is plan 3 since it gives the highest EPS. And the question also asks you to find out the financial leverage. So financial leverage, what is the formula? It is EBIT divided by EBT. So EBIT divided by EBT is 1 times here. In this case, 1.064. Here it's 1.072 and here it is 1 times. Now, moving on to one more, the next question. Delimited. Delimited earns a profit of rupees 3 lakhs per annum. 3 lakhs per annum, and they say it is after meeting its interest liability of rupees 1,20,000. So you know that EBIT, they have not given, but you know EBIT minus interest will give you what is EBT. So EBT is 3 lakhs because they are saying it is the earnings after the interest liability is 3 lakhs. And you know, interest is 1,20,000. So what is your EBIT? It is 4,20,000. 4,20,000 is your EBIT. So 4,20,000 minus interest will give you EBT, which is 3 lakhs, right? Now, the tax rate is 30% and the number of equity shares, 80,000 equity shares of rupees 10 each. The retained earnings amounts to 12 lakhs. 12 lakhs is the retained earning, that is undistributed profit. The company proposes as an expansion plan for which rupees 4 lakhs is required. For the expansion plan, the company needs 4 lakh rupees. So how the company wants to raise this amount? They say that it is expected that after expansion, the company will be able to achieve the same return on investment as at present. So whatever the rate of return on investment, the same percentage the company will be able to earn in future as well. That is after expansion. That's what the question says. The expansion funds can be raised either by issuing equity shares at par or by debt. So they can go in for issuing new equity shares, or they can raise the funds by raising debt at the rate of 12%. Now we have to choose the better, which is the better plan, whether it is issue of equity shares or by raising debt. That is what the question asks us to find. So how do we do this? We will see now. First one, you know what is what is EBT? EBT is rupees 3 lakhs and interest is rupees 1,20,000. So EBIT will be equal to 4,20,000 because 4,20,000 minus 1,20,000 only will give you 3 lakhs. Okay. So EBIT is 4,20,000. Now, what is the capital structure? We will prepare the capital structure now. First one, equity share capital. What is the amount? Existing. Existing equity share capital. The number of equity shares is 80,000 shares of rupees 10 each. That means 8 lakh is the existing equity share capital. The company also has debentures. How do you know? The company is paying debentures at the rate of 12% per annum, and the debenture interest is 12 lakhs. Now, please remember, if you want to know what is the value of debentures, what you should do, the debenture interest is 1,20,000. This divided by 12% will give you what is the face value of the debentures. So what is the face value of the debentures? It's 1,20,000 divided by 12%. It is 10 lakh rupees. And the company also has retained earnings of rupees 12 lakhs. So what is the retained earnings? 12 lakh rupees. So the total capital um, is 30 lakhs. So 30 lakhs is the total capital. On 30 lakhs, the company is earning a return of EBIT is 4 lakh 20,000. So if you want to know what is the return on investment? What is the return on investment? EBIT as a percentage on the capital invested. So it will be 4 lakh 20,000 is your EBIT, and the in capital that you have invested is 30 lakhs. This into 100% will give you in percentage. So what is the amount? So how do you calculate EBIT? What is given is 4 lakhs, 4 lakh 20,000. So what do you get? 4 lakh 20 divided by 30 lakhs into 100. 4 lakh 20,000 divided by 30 lakhs will give you how much? Will give you 14%. So it will give you 14% return. So EBIT divided by the total capital into 100 will give you 14%. So if after your expansion, what is your expansion? After expansion, your capital will be 30 lakh plus 4 lakhs, which is 34 lakhs. Okay, on 34 lakhs, 14% you have to compute, because the question says after expansion, the company is expected to earn the same return on investment as at present. It's given in the question. Okay, so after your expansion, these things will continue here. And the 4 lakhs, if you want to issue shares, so the first option is going for issue of shares. So new equity shares will become how much? New equity shares of rupees 10 each. New equity share capital will be, because you need 4 lakhs, the company can go in for issue of equity shares at par. That means the company can raise the entire amount, 4 lakhs in shares. The other option which is available is the company can go in for issue of debentures at the rate of 12%, debt or borrowings, whatever, 4 lakh rupees. So in both the cases, the company is raising 4 lakh rupees. One option is the company can issue equity shares. The other option is the company can go in for issue of debt. Okay, so this is what is given. Now we will see calculate what is EBIT. EBIT, you know that it is at the rate of 14%. 14% on your capital employed. So what is the capital employed in the case one? It is 34 lakhs. This into 14% is 3 lakh 76,000. The same thing holds good for the second plan. Now, in the first plan, you are going in for issue of equity shares. Now, you already have 12% debenture. So 12% debenture interest will be, it is 10 lakhs is the debenture. This is your capital structure. This into 12% will be 1 lakh 20,000. And there is no other interest payment. So this is 0. So what is your EBT? It will be EBIT minus the interest on debentures minus the interest on debt. So it is 3,56,000. 3,56,000. And you know that the tax rate is, what is the tax rate? Tax rate is 30%. Therefore, you pay 30% tax. On your EBT, you pay 30% tax. Then you find out what is the profit earnings after tax. Earnings after tax is 2,49,200. Now, Do you have preference dividend in the capital structure? You don't have. There is no preference dividend. So the entire amount, that is 2,49,200, belongs to the equity shareholders. That is 2,49,200. So 2,49,200 is the amount that belongs to the equity shareholders. Now you find out how many equity shares are there. So first one, you already have 80,000 equity shares, because equity shares of rupees 10 each, the share capital is 8 lakhs. So 8 lakhs divided by 10 is 80,000. And the company is planning to issue 4 lakh equity shares of rupees 10 each. That means 40,000. So 80 plus 40 is 1 lakh 20,000. So in the first option, the number of equity shares will be 1 lakh 40. Therefore, EPS, earnings per share, that is earnings available to equity shareholders, divided by the number of equity shares, EPS is 2.08. Now, in the same manner, we will see what is for financial plan 2. So EBIT, you know, it is 14% of the total capital employed, which is 4,76,000. There is debenture interest, 1,20,000. And the 4 lakh that is required for expansion, you want to go in for debt. So you have to pay interest at the rate of uh, 12%. So 12% of 4 lakhs is 48,000. So what is your EBT? EBT will be 4,76,000 minus 1,20,000 minus the tax minus the interest on debt. You'll get 3,08,000. You know 30% you have to pay tax. So find out what is 30% of 3,08,000. It's 92,400. You get EAT. There is no preference dividend, so the entire amount belongs to equity shareholders. So 2,15,600 minus the preference dividend will give you 2,15,600 only, because there is no preference dividend. Divide this by the number of equity shares. How many equity shares in the second option? 80,000. That is 88 lakhs divided by 10 is 80,000. So the earnings per share under the second option is 2.70. Since the EPS is higher in the second plan, the better plan is to raise 4 lakh rupees by 12% debt. Okay, I think that's what they have asked you to calculate, and we have calculated. So which is the better plan? The second plan, that is raising the required 4 lakh rupees by debt, will be the better option. I hope you have understood the concept. Thank you very much. Have a great day.